The Fed has gone big and fast with rate cuts and lending programs, and now you're going to be standing up a big lending facility. When you consider everything you've done and what you see in the economy, what are you thinking right now?
So let's start where you began that, and that is with the rate cuts that we did at the emergency meetings earlier in March. So we reduced the federal funds rate by 150 basis points. Normally we would expect that to flow through to other financial markets pretty seamlessly, and you would see borrowers, both individuals and firms, seeing lower costs as they tried to borrow funds. Unfortunately, the plumbing in the financial system was overwhelmed by the number of people trying to sell whatever assets they had and get into cash. And so some of the interest rate reductions that we did, which are primarily at the short end of the market, hasn't perfectly gone through to the rest of the market. These facilities that we're setting up are intended to, in effect, getting the plumbing better. So the New York Fed has been buying mortgages and Treasury securities. I'd say the Treasury securities market is operating reasonably well. The mortgage market is operating much better than it operated a week or two ago, but still is not by any means all the way back. Some of the commercial paper markets, some of the shorter-term markets are seeing margins come in, which is a very good sign. It means that the lower interest rates are starting to be passed on to firms and households. But I think it's going to take some time. So the primary goal of what the Federal Reserve is doing is trying to reduce the amount of spillovers that occur. So there's not much we can do about the health crisis that was created by COVID-19, but there are things that we can do to limit the amount of spillover to financial markets. And I think the fact that we quickly got our facilities up, and there's still more facilities coming, has helped in reducing the amount of financial spillover, but not completely eliminated it.
Well, the Boston Fed runs the money market facility. Last week you provided more than $30 billion in that market. How is that one working?
I think it's working pretty well. So by its name, the money market liquidity facility, clearly we're focused on money markets. There are different kinds of money market funds, and the ones that are government-backed really have had inflows, not outflows, and have experienced no problems at all. A second set of money market funds are the prime money market funds, which borrow high-grade corporate paper, and to the extent that corporate paper wasn't trading because people were trying to get into cash, it was very difficult for money market funds that were prime money market funds to get their required liquidity as people were trying to get into cash. Similarly, there are municipal money market funds focused on the tax-exempt sector. Those are mostly to retail, so it's mostly individuals that are involved in that. And municipal debt was not trading very actively either. So I think our facility has helped in bringing those margins down. We have, for the most part, seen the outflow from prime funds and municipal funds flattening out, and in some instances actually starting to increase again. So our primary purpose was to make sure that money market funds didn't get to the point where they had serious liquidity problems, and I think that goal has largely been achieved to date.
Do you have any details yet on how the corporate lending facility and the Main Street lending facility will operate, or even when they will begin to operate?
So the commercial paper facility should be up and running relatively soon. The corporate facilities that are more focused on investment-grade corporate debt of a somewhat longer term going to take a little bit longer, and the Main Street is still in the design phase, so it's a complicated facility to appropriately scope, so I think it's still going to be another couple of weeks.
Do you worry that they won't be up and running in time to save a lot of businesses?
We're doing these facilities as fast as we can, and like every organization, we're dealing with a lot of people that are working remotely from home. And in addition, we need to make sure that banks and other organizations understand what the nature of the facility is, get paperwork in that's necessary to run them. So unfortunately, these facilities do take some time. We're doing it as fast as possible. Hopefully, we will have the facilities up and running to help a large number of firms over time.
Perhaps anticipating an economy in free fall, you called last month for the Fed to have the legal power to buy equities. Do you still feel that's necessary?
So my previous speech just talked about the ability to do open market operations. And right now, for open market operations, we can only purchase Treasury securities and mortgage-backed securities that don't have any default risk. If we wanted to very quickly enter these markets, we would have to have the capability that many other central banks have, which is to purchase, for example, high-grade corporate debt directly for open market operations. I think it actually would be useful to have that capability during a period where the country's experiencing an emergency. That would actually require an act of Congress, so that's not something the Fed can do. As a result, we're trying to do things through facilities. These facilities require getting special purpose vehicles set up and having a lot more paperwork than directly purchasing securities. So that's one of the reasons for the delays. If we had the capability during an emergency to buy a wider set of assets, then we would be able to start purchasing things much more quickly.
Well, you are, in effect, buying corporate bonds and lending to investment-grade companies, but there's a debate. Should you consider less than investment-grade businesses or even leveraged loan funders with the money that you'll get from the Treasury from this new rescue package?
Well, I think our focus first has to be opening up markets where people are very creditworthy and where the likelihood of loss is relatively low, but where trades are not occurring. So I think we need to focus on those markets first. It is harder to structure a facility with enough Treasury backing as you get to greater risk securities. So even though the Treasury, as a result of the new legislation, has a much more capacity to backstop Federal Reserve facilities, I think it's important that we focus on high-grade markets first, see how much Treasury capital gets used up for those facilities, and then over time think about whether there should be further expansion.
I know that in a situation like this, you're worried about putting the fire out more than how much damage the water may do. But with the Fed's balance sheet over $5 trillion now, how big do you see it getting? And is there an upper limit, a point at which there might be unintended consequences, as you found last September when you were shrinking the balance sheet?
Well, my hope is that if we're effective, some of these facilities won't have to do as many purchases. So the goal is to bring in some of the spreads for borrowing. We've already seen some of that spread compression, particularly at the short end of the market. So, for example, the facility that Boston is running, the money market facility, we have seen the flow into the money market facility has come down as the spreads have come down in the municipal market, the commercial paper market, and for bank CDs. So that's a positive sign. Our goal isn't to expand the balance sheet. Our goal is to make sure that markets start operating in a more effective and efficient way.
Nobody working means no tax revenue and big shortfalls for states and cities. You mentioned buying muni paper. Now that you've got congressional permission and encouragement to buy muni bonds, how far should the Fed, the monetary authority, go in financing governments?
So we obviously have to be careful about that. We're focused on high-grade municipal debt at this point. I'm very comfortable with us buying high-grade municipal debt and making sure that market functions well. Also, an awful lot of retail investors that invested in money market funds that were focused on buying municipal debt want to be sure that they're able to get their funds out. I think that is completely appropriate.
What are CEOs and even the mom and pop stores in your district telling you now?
Well, unfortunately, a lot of those organizations have laid off a significant amount of their hourly workforce and frequently a relatively significant part of their salaried workforce. I would say that is particularly true when you think about organizations that have been severely impacted by the nature of this public health crisis. So Retail, particularly to the extent it's stores that are being closed down. Restaurants, the same thing to the extent that they can only provide takeout or are not providing any services, anything travel related. So in those areas, the layoffs have been quite substantial. I am expecting initial claims to continue to go up quite dramatically, and I would expect that the unemployment rate would rise quite rapidly as well.
Do you have a number on unemployment or one for GDP?
So I would focus that our models are not particularly accurate. At this stage, we rely on models that primarily use historical data. The last pandemic was more than 100 years ago, so that's not in our database. So the ability for us to use our traditional statistical models to get the kind of accuracy we would normally have don't have the history of these kind of events. So I would take any forecast at this stage with a large grain of salt, and I would also add that a lot of the forecasting is tied to how significant the social distancing works in enabling people to come back to work and for people to be healthy. Those are still in the early stages of understanding how successful we're going to be with that. But I would expect that it's quite likely by the end of this quarter that we'll see an unemployment rate that's probably going to be north of 10%. Hopefully not a lot higher than 10%, but I think that seems ballpark reasonable to expect. I think the bigger issue is whether we're able to contain problems both in the public health sphere and also the financial spillover sphere to make sure that that unemployment rate doesn't stay as elevated over time.
One last quick question. You're going to have perhaps trillions in lending to American companies, big and small, and that'll be at near zero rates. Are you ever going to be able to move rates higher given the risk to borrowers, or interest rates now, for now at least, finished as a Fed tool?
Well, I think the federal funds rate is now as low as it can get without going negative. My own personal view is that we should probably avoid having negative short-term interest rates. So that vehicle, I think we will not be able to use in the near term. But these facilities are providing significant amount of stimulus. The purchases of long-term Treasury and mortgages are providing stimulus. So we're bringing long-term rates down. But there are limits to how much these programs will be able to get the economy running. And some of this relies on fiscal policy being effective. So we just had a very large bill passed. It wouldn't surprise me if we're going to need more fiscal stimulus given the nature of the shock.